Hi, this is Daniel, and you're watching Unrivaled Investing. I believe the ongoing stock market crash has the potential for those that can act on it to create immense opportunities of multi-generational wealth building. That said, I also believe most people will not be able to act on it because most people do not have what it takes, in my opinion. That means you have to have the patience, you have to have the discipline, and you also have to have the cash when the opportunities are available. So that means, hey, I'm going to wait for the fat pitches. I'm going to wait for when I can conservatively pencil out stocks where I'm looking at 200, 300, 500% upside and then make that swing. And most people at that point, when stocks are priced at that level, they won't have the patience, they won't have the discipline to act, and they also won't have the cash because they will have used it up at all the little buy the dip opportunities along the way down there. So as I believe this is playing out, the stock market crash that I've been calling out for arguably over this past year, there are some updates that you should know right now. So one of which is you see Dr. Michael Burry, arguably one of the greatest investors in the world, and look, he's saying this could be even worse than 2008. And he tweeted about this earlier this week. If you don't think, he's one of the greatest investors, I recommend that you actually learn a little bit more about his track record because it's well beyond one great call about the financial crisis. It was anticipating inflation recently. It was also, effectively really navigating the dot-com bubble extremely well, performing well there, and also having years of outperformance before that. So it is important to understand this is not a one-trick pony. This is one of the greatest analysts in the world in terms of looking at individual businesses. So when he says, hey, I think this could be worse than 2008, he's wondering it aloud. He's talking about what our interest rates are doing, exchange rates globally in terms of, massive swings. Central banks seem reactionary and cover your ass mode. One of my analysts said it was spooky that today I would wonder that Alpine. He's talking about it's spooky that he's worrying about that it would be worse than 2008 when it was actually the anniversary of, I think, one of the largest drops in the Dow Jones in September 29th, 2008. And you can understand what he's talking about. I mean, looking at bond portfolios absolutely crushed. Long-dated U.S. Treasuries down nearly 30% year to date. So think about all those investors that think they're conservatively positioned in treasury bonds that have lost 30% this year. I've also previously called out saying, look, if you have government bonds yielding 4%, and that's the direction we're heading at, then you might say, hey, the S&P 500 should probably yield maybe 6 to 8%. Given that you want to get some sort of spread off of a sort of the risk-free rate, in which case maybe you're looking at an S&P 500 price of, let's say, 2,500 to 3,300. So in which case maybe you're looking at a 50% drop. So that does raise the question, well, wait a second, if I'm penciling out all in a 50% drop peak to trough, maybe it's worse, maybe it's better. How is that potentially worse than the great financial crisis when you're looking at like the system was potentially shutting down and you saw a similar decline in the stock market? Well, the way to understand the difference is sort of subtly is that the great financial crisis was about transferring banking and insurance liabilities to the government, sort of saying, hey, we, Lehman Brothers, we can't handle the fact that we have all these liabilities and we also bought all these crappy, effectively these subprime assets that are now worth a lot less. And now we have this hole on our balance sheet. And so if you just let them explode, then it sort of creates a daisy chain problem. That was the problem with Lehman Brothers. So then the government said, okay, we're not going to let that happen. We're going to provide bailouts. We will sort of inject capital into the balance sheets of all these banks and insurance companies to make sure there isn't a key problem, particularly AIG in particular, when I say insurance companies. And so this was sort of transferring that risk from those businesses, those corporations, to the government. That was really the great financial crisis, and sort of the government stepped in to smooth things over. Now we're facing a sovereign debt crisis where investors are increasingly losing faith in their governments. And this is partly because you see governments that already have high debt levels looking at rapidly expanding deficits, partly in response to exploding energy bills, particularly in Europe, but also rising rates. So you're sort of getting this 1-2 punch of saying, hey, we're going to have higher deficits because, XYZ external factors like covering energy bills. So, our consumers and our businesses don't blow up. So you have rising deficits. Oh, by the way, those deficits are going to cost even more because, by the way, interest rates are going up because we have to tackle inflation. So this is a really big challenge for a lot of G7 countries, and you look at what's going on, you look at interest rates moving up, and now you're seeing another unexpected sort of black swan type of thing where you're seeing UK pensions say, hey, we're having a potential margin call. And this is really surprising for folks because normally you don't have margin calls. You don't have run on a pension fund. It doesn't work like that. People don't normally like, hey, can easily pull their capital out of a pension fund. That's not how it works. Usually it's very scheduled. Okay, this is the amount that's due over the next 30 years. But what happened was because interest rates were so low, it made a lot of these pension funds think that they were dramatically underfunded. And so what they ended up doing is they borrowed a lot of money to buy long dated bonds. And as they borrowed money, they levered up to sort of say, hey, we're not as underfunded as you think, because look, we made this big bet borrowing money to buy long dated bonds. And that's what a lot of these pension funds did. They borrowed money to buy long-dated government bonds. But as I talked about earlier in this video, that portfolio of long-dated government bonds is getting crushed this year. It's down 30% in the US. In some countries, it's even worse. And so these pension funds that had borrowed money to buy long-dated bonds, they're getting absolutely killed. And then their borrowers or their lenders, because they borrowed money to make this happen, their lenders are sort of saying, hey, you need to put up more money. Where's the margin? Where are you going to put that up? And so just this past week, several different UK pension funds were hit with £100 million margin call, which, created this risk of like, hey, are you going to have forced selling of your portfolio? So then the Bank of England quickly stepped in to say, hey, we'll make sure everything's all right. We're going to start buying our own bonds to lower interest rates. So that way your losses, your mark-to-market losses aren't as bad, sort of trying to rescue some of these funds. So, look at everything that's going on. These are some epic blowups where, you're sort of saying, hey, the foundation is at risk. And by the way, so are the underlying governments, where people are starting to say, hey, I need to get paid more with these various different government risks, government debt exposure. And this raises the question of when will things start breaking elsewhere? I mean, this is what we just saw this past week in the UK. When will you start seeing other pension funds, other institutions around the world, who else effectively has been, swimming naked? Now the tide's coming in. Let's see what happened. Let's see who's been levering up, and buying things that really they shouldn't have done. And now that effectively bond prices are collapsing, who's the ones that are blowing up their balance sheet? And I don't know who that's going to turn out to be, but I strongly suspect the UK is not alone in this case. And so it's going to be a very tough question for central bankers around the world to sort of say, hey, do we let these institutions fail, or do we sort of try to pivot and have this both inflationary fight as well as preventing some of these institutions from imploding? And you don't want to have an institution imploding. That creates forced selling, and then you have sort of this death spiral. So this is a very tough position to be in. So then the question is, okay, so how do you possibly capitalize on arguably this stock market crash, this ongoing calamity? Well, first, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. In full disclosure, this is not financial advice. So I think it is worth, taking note of where we are. Michael Burry, he discloses, his quarterly filings. And I did a prior video on this saying, look, he effectively went 99% cash, at least when it comes to his US holdings. That's a big deal. That's effectively his way of saying, yeah, the risk reward isn't that compelling. Once again, I think Michael Burry is one of the best analysts out there. Stanley Druckenmiller, arguably one of the greatest, 30% compounded for 30 years, not a single down year. And he cut back his risk by something like 70%, over the last year, where he manages his own money, around $4 or $5 billion, and he cut it back to like $1 billion in exposure. So another one of the greatest investors of all time. So I think it is, worth understanding, like, hey, when you have some of the greatest investors of all time cutting back, should you consider doing the same? And that's sort of the first point. Like, what do you know? And I'm not trying to like put you down. What I'm saying is, what do you think that these guys don't know? Because the reality is, investing is an incredibly humbling business. And so it's worthwhile to sort of size up, like, what's special about the business that I own that can weather this calamity, can weather what I'd argue is a continued stock market collapse. And this is why I show this. I previously did a video on Apple. Yes, stocks have sold off. And a lot of people are going to say, Daniel, you're trying to time the market, yada, yada. I am not trying to time. I'm not trying to bottom. I want bargains. I want fat pitches. I want low foot, 1 foot hurdles to be jumping over when I'm looking at incredible bargains. And that is not what I'm seeing here, because I call out Apple, trading at a mid-20s, earnings multiple. I call out Costco. These are both exceptional, unrivaled businesses, but they both trade at very full multiples that give zero credit for a tough 2023 potentially, which is looking at arguably an environment of potentially a deep recession. So I look at this and a lot of people, oh, the market's already pricing it in. The market will price it in when you can see a cheap valuation. When you still see very high and very full valuations, that's not cheap. I remind folks that Apple within the last decade traded at 10 times earnings, actually less when you look at their cash balance. So I'm not saying that that's where it's going to go, but I am saying we are sort of looking at two different ends of the spectrum. I do not think that a lot of valuations are anywhere near cheap. There are some that are sort of interesting, but it's unclear how much they're sort of factoring in tougher economic environment. So how do you potentially capitalize on this environment? So one, everything you own, you should check against it and ask yourself, what do you know about this investment that maybe some of these great investors, have overlooked? Sort of what's that sort of secret? And so then the next key component, because I do have, my portfolio of holdings and I do have a very large cash balance. So for my holdings, I'm sort of saying this next key question is for my largest holdings, what are you going to do if there's a calamity? And how will this company get stronger if there's a stock market collapse? And honestly, there's a couple of easy ways to do it. You can sell off expensive assets. You can use your cash to buy back stock at cheaper levels. Like I love the fact that some of my top holdings rapidly buy back stock when it's cheap. I mean, that's just fantastic. So I'm actually rooting for the stock to go lower because I'm sort of saying, hey, I'm in it for the long haul. I would love for the stock to go to a crazy low valuation. I'm going to own even more. Another aspect when you're thinking about these businesses is, hey, does this company actually benefit from this rising interest rate environment? You think about a company that has a large cash balance. Hey, now you're actually going to start collecting real interest income from that. That's a benefit too. And by the way, that cash balance, I have my, investment accounts at Interactive Brokers. There's a link below. Now it's getting something like 2.5%, on the cash. So that's not nothing, unlike where it was a year ago. And so I think the third key aspect that you could use to leverage this stock market crash ultimately for your own investment journey, over time to look for these opportunities is why not just say, hey, if Michael Burry is one of the greatest investors in the world, if, Stanley Druckenmiller, one of the greatest investors in the world, why not wait to see when they start putting in a lot more capital and see what they're buying? Yeah, you may not get the absolute bottom, but you might get it within 30-40% on its way up 500%. So, I mean, and that personally, I love shopping around, seeing what they've done. Last year I called out to my Unrivaled Investing subscribers. I was like, hey, there's this company, here it is, McKesson. It's one of the top players in terms of shipping drugs around the United States. It's a wholesale distributor. I mean, this is an incredible business. It's an oligopoly. And I said, hey, it was trading at 8 times free cash flow. I got the idea partly because I was looking at Michael Burry's holdings. I had looked at the space previously as well, but I saw that he bought it. Okay, it was great. Subsequently went up 60% the next year, and I called it out to my Unrivaled Investing subscribers. So that's, why not? If you think that, hey, some of these guys might actually know something, and they have billions of dollars to their name, why not leverage their knowledge over time with the quarterly filings? And by the way, now you're actually starting to collect a little something with your cash balance. And by the way, you look at a lot of great companies and the valuations still aren't crazy compelling. Now, if you disagree with me, if you think, Daniel, I'm trying to bottom ticket or I'm trying to, find the bottom of the market, that's not what I'm doing. Once again, I want fat pitches. What I'm thinking is that if you think that there are some super deep, compelling deals, feel free to leave a comment below. I would absolutely love to get a list of companies where you're saying, hey, this company trades at 15 times free cash flow. And I don't want these nonsense price to sales multiples. That works in a, funny money environment like we've had the last few years. Now I want real free cash flow. Show me some companies where you're saying, hey, this trades at 15 times free cash flow. This company trades at 10 times free cash flow. And I think it's going to keep growing at 15 to 20% a year going forward. Give me a list of those and I'll say, okay, now we're potentially talking about some deep value, really compelling stuff that is worth buying. But if you're talking about, let's say, an RV manufacturer and you think that's cheap, well, wait a second, folks. Are you looking at a really cyclical business? So this is what, if you think that there are really deep, compelling deals right now in your portfolio, call it out, call out the free cash flow multiple and why you think this company that you think is a top position is going to keep growing. I'd absolutely love to hear it. And I'll respond to you in the comments below. If you enjoyed this video, please make a point of hitting that thumbs up, hit that subscribe button, and thank you for watching Unrivaled Investing.